To give the commissioners a little bit of background, what I'm going to talk about has to do with what we discovered during the process of coming to market with your 35 million pass-through toll bonds. And what we discovered as we were preparing the offering documents, the county had an imbalance in their interest in sinking fund and in their general fund. And what was happening is only a small amount of money was being used in the interest in sinking fund, and it was being moved over into the general fund. Can't do that. So what we recommended to the county, and the county did this, is that we postpone the sale of these bonds. We were going to sell them about a year earlier than what we anticipated. That we postpone the sale of these bonds and get that structural imbalance cleaned up. Let me tell you why we did that. As we go through these rating reports, you may expect the rating services to run ratios and have all kinds of numbers and so forth and so on, and then they assign a rating. But in fact, in addition to all those numbers that they run, we also have, and I'll call it, for lack of a better term, a black box, and it has to do with management. It has to do with financial management. It has to do with policies and procedures and so forth and so on. And so one of the things I wanted to do is just to make sure when we went into Moody's for a rating on this, that we did have this, I'll call it cleaned up, so to speak. We reallocated the funds, the tax rates, and it resulted in a substantial imbalance in the general fund at that point, because we actually had to lower the tax rate on the general fund. And so there were a number of things done, and I'm not going to go over that with the commissioners. I'm not even familiar with it, but I do know there were a lot of cuts made. And I was fortunate to listen to the presentation of the auditor, because I'm also not an expert in financial accounting. One of the things that Moody's, if you'll look at the September 2012, they took a hard look at the county and all the information we had leading up. They looked at audits, they looked at budgets, they looked at debt position, unallocated funds in the bank, fund balance. That's flexibility as far as the county's concerned. And what they saw, if you look at the bottom of that first page, the cover page, they pretty much detailed it out just in bullet points. And then they go through the rest of the report talking about the bullet points. The strengths: moderately sized tax base, experiencing continued modest growth. Well, that's not a surprise to the county. Challenges: trend of structural imbalance. What that refers to is, over an extended period of time, the county has been spending down its unallocated fund balance. And my memory says that's primarily the result of jail operations. So jail operations were good, jail operations became bad, county had to make some adjustments there, but that fund balance has gradually, over the years, been spent down, and that's the structural imbalance that they're talking about. Narrowed financial position. So what they're really saying there is that it's reducing the county's flexibility to respond to an ice storm, for instance. I know we've had that problem out here. So that's what they're referring to in that particular report. And then we get to this report, which is 26 February 2014. Moody's will periodically come back in and evaluate a credit. And what they're doing is they're not looking at the major, it's not a major look at the rating. What they're looking at is the information that they have, that they received. They make good notes, and they're going through and asking questions. Okay, well, we saw this last year. What's this look like? They'll go through that, and then they'll ask some other questions based on some answers to the questions that they received in 2012. And so it's really just an update. If we were to be selling bonds again, the rating process that we would go through would be much more extensive. Well, as it turns out, looking at the upgrade, looking at the update, as they went through, they began to see some things that are actually reflected back in 2012 and were things that were not adjusted. And primarily, in this case, it's fund balance. And like I say, your CPA, your independent CPA was here talking about fund balance. And he was talking about the composition of that fund balance at the end of last year. You had about plus or minus $500,000 in fund balance with the sale, one-time sale of those capital assets. So without the capital asset sale, you're in a deficit position in your fund balance. And the other thing that they're looking at is they know you've had a tax rollback. They've been through these and a number of other credits throughout the state of Texas and the United States, I might add. So they know that there's an obligation there if that tax rollback election were to be successful. And my understanding is that it's going to be in the neighborhood of 500 plus thousand just in rebating taxes back to the taxpayers, plus an expense amount ends up being plus or minus about $700,000. And my understanding, talking to William, is that number's coming in from the appraisal district. So you're starting out this year, 2013, and these are the 2014. These are the numbers the rating services are looking at. So they know you've got that one-time hit on cash. When I say hit, I mean you were able to sell some equipment, bring your cash back up, but that's a one-time sale. So what they're looking at is what's happening in the current budget year, because they know structurally you're working with a negative revenues, current revenues versus current expenditures. And that in reality, looking at your budgets, I don't know how close they are, I've not looked at these numbers, but what the rating services are concerned with is that that $700,000 is more cash out of your pocket, which you don't have. You're going to have to borrow. And I don't know what the budget was this year, but as an example, if it was the same as the 2013 budget, then without the sale of assets, you're going to be going into about I don't know, I'm guessing another $1.2 million or $1.3 million deficit. But the bottom line, your cash deficit is beginning to pile up. And the concern that I have, and again, Moody's was sitting here saying, boom, we downgraded you 2 levels because we don't like what we're seeing. And then you've got the tax rollback sitting there, and we don't like what we're seeing there because they know there's additional liabilities. They know the county doesn't have the fund balance to just dip in and write the checks. You're going to have to go borrow the funds. And so that's what they're saying in the 2014. Again, they talk about your strengths, which are your sizable and stable tax base. And it's actually growing a little bit. But then challenges, severely strained financial position, rollback election to occur April 2014, volatility in jail revenues and expenditures, slow debt service payout. Well, volatility in jail revenues is nothing new. Slow debt service payout has to do with how we structured that debt service. The state will be paying you back on traffic beginning 1 year after completion of your pass-through toll project. They'll be paying you, and we've got this thing structured such that we'll be calling in bonds based on what the state pays us, and lowering that down, that's gonna increase the speed with which that debt is paid back. But that's the purpose of that, and we see that in the other counties. I think Titus County has quite a bit of pass-through toll debt. Right? In fact, a surprising amount. From my perspective, it's not that it's large or small, it's just Titus County is not a big county, and they had quite a bit of that debt. But what Moody's is saying here is you're on a watch list, you're on a negative watch list, and depending on what happens, we may take some action. So we don't know what that action is going to be. Wednesday, we have a call with Moody's that they've already furnished us with a list of questions, and we'll be talking to them. William will be involved in that conversation. The judge, I assume you will be involved in that conversation.
Yes, I'd like to see a copy of those questions.
Okay, William will have a copy of those questions. And I don't know if you want to pull in another commissioner or not. Obviously, we can't have a quorum in that meeting because that's not from Moody's perspective, that's not a public meeting. They're coming to a conclusion and they don't want to go through with the public all the things that they look at and all the comments that they may make going through that. So we'll get the results of that and we'll get another write-up. And we may or may not get a result, by the way, because they may leave the rating alone. But I can tell you for a fact that they're not going to leave that rating alone for a long time. If we continue what they're considering the structural imbalance, which is spending more than we're taking in. And going down, they're not too impressed with the fact that we're going to the bank and borrowing money to continue that. What they would like to see is they'd like to see a plan from the court addressing this problem. And they're not going to sit and dictate the plan. And I'm not going to sit and tell you. I'll tell you what I think about the plan and how I think they may look at it. But I can't tell you what it is. I can help you put it together if you desire. But probably about a 5-year plan, they're going to want to see, okay, how do we get this ship turned around in 5 years? And as a matter of fact, what they're going to want to see is a fund balance equal to 15 to 20% of the general fund expenditures. So that's an unallocated at the end of the year. Just like you had in the 2013 audit, you had about $500,000. That included the sale of assets. What they don't want to see is the sale of assets. They want to see cash sitting there that the county can use to tough times. It's not that you can't use the cash. That's not the point of the conversation. The point is they want you to have some flexibility to work through things that happen, such as a rollback election. You know, it gives you just a little cushion to ramp down your operations to get where you need to be in terms of your revenues and expenditures. So that's what they're looking for. They're looking for the court to sit down and come up with a plan, and actually they're looking for the court to follow the plan too, but come up with a plan that addresses the problems that you have today, and then how you get back to what their expectation level is to have a rating. Your rating should be in the AA category, and the reason it's A1 when we sold these bonds is because of the comments that they made here, which was trend of structural imbalance, narrowed financial position. You had a history of declining fund balance. So in other words, and as the conversation went, it became apparent that that was a result of the jail operations at that point in time. And so that's why it's listed here more so than anything else. It was the jail operations that were giving the county fits at the time, and that in reality still that in addition to the rollback are continuing to give the county fits. Now, all that being said, I think from the auditor's perspective, he's got to give a cash flow statement, and he's got to do it based on, you know, what your budget looks like today. And I would recommend to you that you're gonna have to take some action sooner rather than later. And counties, like any other governmental entity, local governmental entity, are heavily salaries. And so that's kind of along the lines of services. It may be that the county has to come in and make some determinations. That's the commissioner's job, that's not my job. I'll be happy to help interpret what's been done and how the plan works and how I think Moody's might respond to it. But I will tell you, my interpretation might be, assuming they may take some kind of action, which may be nothing, at this next phone call on Wednesday, my interpretation may not be tested, so to speak, for another year, 18 months, until Moody's comes back and takes another look at it. And we go through the process again. But that's what I'm trying to tell the commissioners, is that right now you're bleeding from a cash perspective. And I've not, well, I have not looked at the numbers, but I have the numbers now that William gave me a copy of today as to how the cash is rolling through right now. And he's, I know he's taken a look at, well, here's where we are. If we go unchanged to the end of the fiscal year, then our deficit's gonna be in the neighborhood of X. And so my purpose here today is simply to say, you're, without some plan of action, you're digging a much deeper hole, and it's going to be more difficult to come out without even, in other words, the more the deficit gets, the more difficult it's going to be to dig back out of it as you go back. And one thing Moody's knows, and it's not any different from you and I personally, is that when you have money troubles, you tend to have political troubles. It tends to kind of stir the pot. Now, they don't pay much attention to current political troubles because everybody goes through some tough times politically from time to time. But what they are concerned with is if they see a long-term look at that, and that may be another thing they look at. We just don't know. That's part of the black box. That's part of what we don't know. But we do know that just in general, when you have money problems, it filters down. My wife is a spender, and we've had to have some conversations. Fortunately, she's understanding, and I have to be understanding. So anyway, that's what I'm here to say. I'll be happy to answer any questions that I can. Move on from there. By the way, let me make one other comment. The county can ignore Moody's. Moody's is not here to tell you how to run your business. In fact, you'll notice in this report, they don't say, this is how you need to run your business. All they say is, this is what we're seeing. So the county can choose. That's a question that's come up before with some of my clients. The counties can choose to look at the report and make some changes that ultimately might get them more in line with the report that can't be made overnight. Let me just say, I'm not saying that can't be made overnight, but typically they're very, very painful just to stop the bleeding like that. There's got to be a process by which you go through and then begin to rebuild, get rid of that negative over time and turn it into a positive. that's why I would suggest to you a 5-year period of time to get that done. But don't feel like Moody's is telling you how to do business. They're not. They're just looking and saying, this is what we're seeing, this is how it compares to everybody else in the country, and so this is the rating that we're giving to you. You've gone from A1 in 2012 to A3 today. You're still on the negative watch list. That'll put you down in the BAA category. You have no other room in the A category. That'll put you in the BAA category. And candidly, the county should be somewhere in the AA category, low to mid AA rating, which is a very good rating. One thing I also want to say, and we've run across this in another credit, and I required them to structure it this way, and we structured it this way at the county as well. I don't know how the construction's going, I don't know how the timeline's going, but we put a 5-year call on these bonds. In other words, the county, at its option, can go in and get these bonds for any reason and do something with them, whether that be write the check, pay them off, whether that be if your pass-through tolls are not coming in as they should be, or if the project's delayed and they're late coming in. And we can go out and pick up pieces of that then and move it where we need to move it. And we have that option, and that's at no cost. If, however, we were to enter the bond market today, I wrote this down, my memory's not as good as it used to be, but when we originally sold, we've got some indicators that are kept by a bond buyer, which is a national newspaper specifically devoted to public finance. And the bond buyer at the time that we sold was 3.67%. So what that is that was an average of 20-year bonds. That's close enough for government work here. We actually sold longer bonds, so it's not a true comparison. But that's the average of 20-year bonds that were sold. It's a market basket of 20-year bonds that were sold during the week that the county sold its bonds. And we talked about that when I was here. The county actually received a true interest cost of a 3.43. Today, that average is running somewhere in the neighborhood of 4.33. So you can see rates have gone up. Long-term rates have gone up. Short-term rates are still very attractive, but long-term rates have gone up. Of course, the county sells bonds short to long, and it's an average. And so today, you'd probably be looking at, if you sold in 2012 and had the market been 4.33, you'd be looking somewhere in the neighborhood of a 4.33 in 2012 if circumstances were the same. Today, if we were to sell, you'd probably be looking, and that, by the way, the county sold below that with longer bonds, and that's good. That means your credit nationally was looked at better than those credits that went into that index. But if the county were to sell today, there would be a penalty for that drop. And whether we could overcome that penalty or not would only be known if we went into the market. But just suffice it to say that your interest rate will be up. And in that case, it's up a pretty significant amount just due to the market. So what I'm trying to say is, if we were to have to get to these bonds, and if we were to have to restructure them for some reason, that rate would go up just based on today's market. But it actually may go up more because of where the county's credit rating is today, where it stands, which is worse than it was in 2012. So I wanted to emphasize that Moody's doesn't run your life. The court runs the life. I'm just here to say, this is what the market looks at when they come in and they evaluate the court. if the court is selling additional debt. Today, there's been no impact on the court. All the impact has been felt by the purchaser of your bonds. He bought your bonds with an A1 rating, and he now owns bonds with an A3 rating. Well, bonds at A1 and A3, that's a difference. It'd be a higher interest rate as a result. So he suffered a loss, so to speak. He can no longer sell that bond if he were to go back into the open market as an A1 bond. So the only one that's harmed at the moment is the bondholder. The county has no, you're not harmed in the least. Your only harm is if you were to come back to the market. And so, given what I just told you, you can go on, you can run this county any way that you want to run it. Moody's is not here to tell you that. They're just here to tell you this is what the credit markets are looking at when they make this judgment. I said a lot. I'd be happy to answer any questions. By the way, I do want to say one thing. And I said it earlier, but I want to emphasize one thing, is remember we postponed this sale for, well, the court, most of the court may not remember, but we postponed this sale for 1 year in order to make sure that we had the tax rates in the right ratio based on what state law dictates. And so the county then went in to a period of time, beginning when we sold bonds, it was levying, figuring, calculating, and levying a tax based on what its true outstanding debt was. You just went through a rollback. The interest in sinking fund tax is not subject to rollback. It is what it is. If it was subject to rollback, then the county, as well as every other local governmental entity, would be selling at substantially lower interest rates than they are today, because that increases the risk to the bondholder of a cash flow default. In other words, there's not enough money in a rollback situation to pay debt. So just know that the interest in sinking fund tax is not subject to rollback. General fund tax certainly is, and right now, at least in my opinion, that's something that's hurt the county badly in terms of finances. So, now, I'll say that again, and then I'll go home if there's no questions.
Questions for Mr. London?
How will this, excuse me, this reduction in our rating, how will that affect this tax anticipation loan? I can only assume that it's gonna be harder for us to get and or pay higher.
You know, that's an interesting question. And I would say this to you, a long-term bondholder versus a short-term bondholder. Someone that buys because of relationships within the community. So in other words, your local banks, if they're a purchaser of your tax notes, they may be looking through what's happening out in the credit markets and looking through to their relationships with the county and how they feel the county may ultimately get to repay that money. I would say if I were to put this out for bid to banks, it would not be looked upon favorably. Now, short-term rates are so low that, and I'm just going to pull something out because I don't know, but let's just say you can borrow money at 1.5% from your local banks on a cash flow basis. If we put it out for bid, we just never know how it's coming in. But I would say the general bank market is going to evaluate that a little bit differently, because they're the ones that have to deal with their portfolio. They're regulated, and any number of regulators come in and look at any number of different things. But one thing they do evaluate is the portfolio, and so I think your banks that are buying would take in a number of things into account before they assigned or offered an interest rate to the county. So, long-winded way to say, I ain't got